morning and welcome to Business Morning. This is the last edition in the week. Thank you for joining us. I'm Chimeze Obi Ewago. We kick off from the global oil market as prices climbed in early trade this Friday, extending gains after OPEC Plus said it would review supply additions ahead of its next scheduled meeting if the Omicron variant hits demand. But prices were still on course for a 6th week of declines. U.S. West Texas Intermediate crude futures rose 27 cents to $66.77 a barrel, adding to a 1.4% gain on Thursday. Brent crude futures rose 12 cents to $69.79 a barrel after climbing 1.2% in the previous session. The Organization of the Petroleum Exporting Countries, Russia and allies, called OPEC Plus, surprised the market on Thursday when it stuck to plans to add 400,000 barrels per day supply in January. However, the producers left the door open to changing policy swiftly if demand suffered from measures to contain the spread of the Omicron coronavirus variant. They said they could meet again before their next scheduled meeting on January 4, if needed. And back here, the president of the African Development Bank, Dr. Akinwumi Adesina, is asking the federal government to show the masses the benefits of taxation before embarking on plans to increase its tax regime. Dr. Adesina, who was speaking at the 51st Annual ICANN Conference in Abuja, takes a swipe at those comparing the nation's tax to GDP ratio to countries such as Norway, where the tax to GDP ratio is low but has succeeded in providing better livelihoods for its people.
This year for their annual conference. This time, the theme borders on building public trust in governance, and accountants from all walks of life, including government officials, are here as they bear their minds on the issue. One of the key issues discussed is how the COVID-19 pandemic led to a decline in public trust of governance globally, thereby exposing the many shortfalls of the government and the private sector alike.
Restoring trust in governance benefits all in diverse ways and creates a society where there is increased social order, labor harmony, inclusive growth and development, and enhances international trade, commerce, and foreign direct investment.
An analysis by the World Bank on trust in political office holders in Nigeria for the year 2012, for instance, came to about 2.2 and further declined to 1.5 in 2017. The president of the Africa Development Bank, Dr. Akinwumi Adesina, who speaks during the plenary session, condemns the call to increase the nation's tax to GDP ratio. He says the tax system should translate into better livelihoods for Nigerians before it is increased.
While tax rates are relatively low in Nigeria, it simply is not an excuse to keep increasing taxes, however. Citizens do not have access to basic services that governments should provide as part of the social contracts.
There were also recommendations on how the government can gain public trust going forward.
People have lost faith in the public systems. And when you search deeper to the root cause of this problem, you will find out that the lack of accountability is at its core. And a reinvigorated public financial management reforms will help us to deliver accountability and to re-establish trust.
Transparency and accountability, good governance, and active citizens' participation remains a critical ingredient to achieving public trust. It is expected that resolutions reached here will help inform the government on how to better build public trust in the years to come.
And the issue of subsidy payments in Nigeria, particularly petroleum subsidy, has been a subject of debate over the years. Fuel subsidies became institutionalized in 1977 following the promulgation of the Price Control Act, which made it illegal for some products, including petrol, to be sold above the regulated price. This law was introduced by the General Olusegun Obasanjo regime in order to cushion the effects of the global great inflation era of the 1970s caused by the worldwide increase in energy prices. However, as it is now, Nigeria is spending so much paying fuel subsidy, and this, many economic analysts say, is not good for Nigeria's economic development. Nigeria has also come under fire from the International Monetary Fund as well as World Bank for the heavy financial burden it carries in providing subsidies. Now, what are the key issues? Why is it difficult to let go of the subsidy payment? These questions and more will be answered by Dr. Kalu Idika-Kalu, a two-time Nigeria Minister of Finance. Good morning, Dr. Kalu Idika-Kalu. Good morning. Thank you for joining us on the program. Great to see you.
Chimezle, could you make it a bit louder, please?
Good morning, Dr. Kalu. Just saying good morning to you. Happy to see you.
Okay, good morning.
All right. Now, various administrations have unsuccessfully tried to remove fuel subsidies since the transition to civilian rule in 1979. I mean, you served in the administration of General Ibrahim Babangida, who tried to do away with petrol subsidy following the implementation of the structural adjustment program. There was a huge uproar against the decision, and this trend has continued till now. Tell me, what are the key issues? Why can't we do away with petrol subsidy?
Well, the first question is petroleum subsidies are not things to just scoop out in one fell swoop. Subsidies arise from the differentials between domestic price in Naira and the external price in foreign exchange, supposed to be roughly very much. So once, because of the management of the economy, the management of the exchange rate, the policies that we're implementing under various programs put pressure on the Naira, and the Naira, once that depreciation is significant, you know, business people can always see a leeway whereby they now begin to see how they can make more profit by carrying that good, which is as it were held low in Naira terms, across the border, whether it's northern, western, or eastern border, what have you, or even in the port areas in the south. So it is not the way we discuss it as if it's just something that somebody can just go and scoop out. If you remove subsidy, you have to make sure that there will be other policy measures that you have to implement to sustain a stable price system between domestic prices and the border price, as we say, or the foreign exchange price. So if you remove it and you don't do anything, of course, the subsidy will come again. Now, having said that, I had written the paper about this thing, which constituted essentially the structural adjustment program. It is in the line with the regulation of the economy, where you are letting the prices more or less determine the equilibrating level for both supply and demand that everybody knows. But if you do not follow through in so many areas, then you can see why this problem has persisted over time. So it's not just a matter of having the will or the bravery or bravado to remove subsidies. You have to address all the macroeconomic policies that also affect the price in the general system of things. So that is why it has lingered for so long.
Now, I mean, in all that you have said, it's no brainer. Nigeria is in a dire economic strait. And now
Yes.
You talked about the issue of the foreign exchange. This fuel subsidy didn't just start now. And even though a lot of people have been talking about, the Naira being devalued and the foreign exchange and all of that, and that is being blamed on what is, happening. Is that really where we got it wrong? Where did we start to go wrong?
Yes, that is a very good question. The few minutes that I can speak to this will really be quite inadequate to get to all the issues. But when we talk about a structural adjustment system, it's in Korea where the program was first implemented, and I was a very much part of that program, or in any other country, it is not a system that you implement in one budget or in one plan. Structural adjustment is a continuous process, particularly in a developing country, where the changes in the aggregates, the sub-aggregates of demand and supply are changing in large measure because you are going through structural change. You are developing agriculture, you are developing non-agriculture, you are getting the gas and the oil, you are going into the services industry, the entertainment industry. As you know, a few years ago, all of these were revalued, and that put Nigeria ahead as #1 economy in Africa. So literally, these quantums continue to change. But the way you manage your exchange rate, your interest rates, your money supply, your tariffs, your taxes, the income structure, the allocation of resources, all of these things impinge on the general price level. And those have to be guided, not entirely by the vagaries in the price system, but more or less, as you can see, even in our local markets, when prices are going high, it's easy to see why, because supply is falling short. We are far from the harvest time, and then when they begin to fall, you know we are getting close to the harvest time, or there's a relative abundance. It is the same principle. It is not from the IMF or the World Bank or ADB or anybody else. So the way you keep the system in balance, as it were, like in every other sphere, is to maintain that balance. You let the pressure of supply and demand more or less reflect the price. Of course, every government, right down to the most advanced, the US, Germany, UK, they watch these systems, but the changes they make, and that's the mistake we make, we think that they are all implementing what we are doing. The changes they make
All right, Dr. Idika-Kalu, I guess the network is really not friendly now, but I want to believe you can still hear me. In the interim, the government is saying that they are willing to dole out about 5,000 naira to the people they described as the most vulnerable, for a period of time. What's your take on this measure? We regret we seem to have lost Dr. Kalu there. We hope to reconnect with him. In the interim, let's just take a quick break while we do that connection. All right, while we wait to reconnect to Dr. Kalu Idika-Kalu, let's just listen to the NNPC GMD talking about how much the country is currently spending in petrol subsidy.
At market price, and we're selling at 162 naira per liter today. Looking at the current market situation, the actual price could have been anywhere between 211 that you have mentioned and around 234 naira to the liter. The meaning of this is that consumers are not paying for the full value of the PMS that we are consuming, and therefore somebody is bearing that cost. As we speak today, the difference is being carried in the books of NNPC, and I can confirm to you that NNPC may no longer be in position to carry that burden. Because we cannot continue to carry it on our books. That is why early last year, if you recall, the full deregulation of the PMS market was announced, and we have followed this through until we got to September when prices shifted above 145. Some social issues came up, particularly with trade unions and other civil societies, leading to an engagement between us and organized labor, which prevented the eventual implementation of the actual market price of the petroleum product at that time. Those engagements are continuing, and the objective of those engagements is actually not to prevent deregulation, but to make sure that there is sufficient framework on ground to ensure that consumers pay for the actual price of this product and that they are not exploited. So those engagements have been matured so that we can deliver on the promises of government to make sure that alternative fuel is created. Certain benefits are put on the table which will ease out any pain that will bring. So as we speak today, I will not say we're in a subsidy regime, but we're in a situation where we are trying to exit this subsidy or the underpriced sale of PMS until we come to in terms of the full value of the product in the market.
All right, that was Melekiari, the group MD of NNPC, talking about how much Nigeria currently spends in petrol subsidy. Well, we have Dr. Kalu Idikakalu back with us now. Well, Dr. Kalu, well, listening to the NNPC GMD, it is now imminent that removal of subsidy is inevitable. It is also believed that subsidy is approximately at 3 trillion naira a year. That's almost 20% of the budget and, of course, 50% of the fiscal deficit. Therefore, what do you think are the implications of removal of subsidy on macroeconomic stability?
Well, the first thing I should say is that I'm not very comfortable with the way the government statement is coming across. You see, this question of when you determine to remove subsidies of that amount, of that magnitude, you have to think, as you just said, what impact it will have on the general price level, and that affects the savings, investment, procurement of so many other things, income levels, and so on and so forth. When it gets to this level, what should be properly advised is that there will be a phasing, yes, provided you stick to that phasing. You may decide to remove 25% and maybe 50%.
Really not a good day when it comes to technology and internet. Anyway,
in place
okay.
To influence that impact, if you are removing 100%, which I opposed when it was being tried during the previous Jonathan administration. The issue was not to remove or not to remove, but since you waited so long to do it, you phrase it in order not to, I think, to upset the economic forecast. You have to do it in a smooth way so that the injury is not so much. And some of the things you have to do is you think of the elasticity of demand for all the products, where this thing comes to go. Will people adjust? Are you providing transportation? Are you providing housing benefits or something of the sort? So you have to look at the whole range of things that will be affected drastically by the one fell swoop removal, or even when you take it into two stages, into two parts. So this is what I want to hear the government to say. We are going to do this, and this is how we are going to cushion the impact of this removal. It is not the bravery of bravado of doing it in one person that is impressive. It is not put into place the policies to ameliorate the overall impact, and secondly, come out with specific macro and micro policies that will make sure that these policies, these subsidies don't begin to come up again. That is the issue of making sure that all those things that affect disparity between domestic petroleum prices. Of course, you know this all goes to talk about the sources of supply, refineries, the importation, the cost of importation, all the duties pertaining to importation, tariffs, storage, and so on and so forth, as well as accessibility to your other sources. These are all the major macro policies that have to be in place before you just say you are so determined to remove it. That is not what should be impressive. What should be impressive is the overall macro policies that will cushion the impact and also prevent the re-emergence of subsidy.
Right, Dr. Carlo, talking about overall macro policy that will cushion the effect, at least, the government believes that the people that probably might be most affected are the people they describe as the most vulnerable, and they are offering 5,000 naira to these people for a period of time. Is that also a way to go?
That is too customary and casual. As I said, in many cases, I've been there over and over, you don't get a unitary direction in terms of policy impact. There are several people that will be involved, and it's not just people who are also in the government who can deliver this to perhaps service to go outside the public sector. But nonetheless, as I said, given the real value of 5,000 naira, it's actually because of the depreciation of the exchange rate over time, that may not be enough. You may want to do something in quantum that has economies of scale, reduction of suspension of housing. In America, they've done that. They use palliative to make sure there are people out there who've not been giving pensions, from what I hear, for unbelievable length of period, like 2 years or 3 years. Giving them 5,000 is not going to have made a rate much. And I'm just giving one example. So yes, I suppose that will go some way, but government has to be a multidisciplinary approach. Finance and transport and housing and health, all of them should be involved to come out with a broad range of palliatives. And you price those palliatives. If it's like the equivalent of $10 and you cannot afford it, you go down in other equivalents to what you can afford, but make sure that the impact spreads through the entire system. But just giving a cash of that stuff. Apart from the fact that cash will put pressure on short-term supply, and if you said it also involve inflation also creeping up again. So what I suggest, without getting all the details from the government policy, I think it should come across to us as something that is fully thought through to affect the impact on income, to affect the impact on production and distribution, and so on and so forth. And secondly, in terms of the elasticity of demand for fuel, something has to be addressed to the areas that people will divert to. If the fuel becomes that more expensive, because this is the import of giving subsidy, what alternatives do people have? Are we subsidizing public transportation? Are we providing train services at lower prices maybe? And so on and so forth. These are the immediate impacts in the transport sector. So this is what I'm saying. So 5,000, well, that will go somewhere, but it's better we have a more robust across the board approach.
All right.
The totality of that may come up to 5,000. It may come out to more, and then the government has to decide just if it can do a little bit more than just a numeric 5,000 naira.
Right.
I don't know. Are you saying this over 2 budget years or just in 1 budget year? I don't know.
Well, it's just for 6 months, according to the finance minister. Anyway, are there lessons to actually be learned from other African countries who pay more for petrol and yet their inflation rate is low? Because the agitation over this removal of subsidy is perhaps the inflation that would also aggravate.
Yes, well, it is not just African countries. You will go to Middle East countries, go to Latin America. Some of them get, of course, much more violent than we get when we protest these things. But as you say, the lessons to be learned is that there are countries that are paying a lot more. But you see, they are paying a lot more, and if you investigate, their incomes may be more better distributed. The incomes are more regularly paid. There are other services, as I just said, in terms of alternatives to buying the highest price of fuel at the new price. They have other alternatives. So that is the secret. In other words, there has to be attention to efficient macro policy management in place so that when these things arise, the cushioning is less severe. The dislocation of the system is not as significant as what you get when you just do all these other suboptimal policies in so many sectors. So the reasons why they are different, as I said, is that maybe the real incomes are higher, they are paid more regularly, there are other services, they have other what we call safety nets in terms of health, housing, and so on, and the fees are managed in schools, primary and secondary, and so on and so forth. There could be a whole lot of other things that actually cushion the impact of such injustice so that they don't get the part of the type of uproar we get in the Nigerian case, where this becomes a major issue with the labor unions, with the various unions, university, campuses, staff unions, and so on and so forth. So we have to look at the broad range of all the macro policies, and this has to feature in the preparation of the budget or the plan. That is why as I said, the whole essence of dynamic management, dynamic balancing of all these factors has to be a continuous process. Social adjustment is not a one-off time of thing. You are restructuring the economy as the economy is veering off from one sector to another sector. We're trying to diversify. As we diversify out of the basic foods into technology and high-tech areas or entertainment areas, as you grow the tertiary institutions, those things are creating a differential in the way resources are allocated. So there has to be continuous structural reform of the economy, or whatever name we call it. You know, when the factor we are debating this, one kept explaining that if you forget about what it is called, it is just reforming the economy in areas that become necessary as changes in demand and supply occur. It's not a staff structural adjustment at fixed in time. What will this happen during the time of SARS? This goes to show that at times we don't quite yet understand it. It's a continuous process. So if we involve policies in a continuous way, these changes will be minimal, and there won't be so much uproar or so much need to flex muscles of bravado or say government has the will. It doesn't require much will. This is simple economics.
All right. Thank you very much, Dr. Kalu Idika Kalu. That's quite interesting there, even though our technology didn't permit us to see you very well and hear you very well. But, I mean, we got the message. Thank you, Dr. Kalu Idika Kalu, the former finance minister of Nigeria. Okay, after the break, we look at the emergence of the Omicron variant and what this would mean for economic recovery. Just stay with us. Well, the outbreak of the Omicron variant has continued to dampen sentiment across all markets. The economic recovery narrative of the global economy appears to have come to a halt as investors worry the new virus strain could reignite lockdowns across the globe. Let's get the perspective of an investment analyst on this development. I'm being joined by an associate investment research at United Capital, Akinloye Ayorinde. Thank you very much, Akinloye, for joining us. Good morning.
A pleasure to be on the show today. Thank you.
Now, this new virus strain poses a high level of concern to the global economy. We have seen markets take a hit because of it. From investment point of view, how are you reading the narrative?
Okay, clearly for us, we're looking at, we've been watching developments as they unfold, particularly across the globe, keeping tabs on what is happening in Southern Africa as well as in the US, and also key countries where we know that a lot of work is being done in terms of researching the impacts of the virus, basically, of the new virus strain. And so far, there's a lot still to be discovered. There's still a lot left to be explored. Most of the information we have right now, are more or less based on small sample sizes, and they don't basically confirm anything yet for now. There are talks around, maybe the Omicron variant may be more infectious, maybe more, transmissible compared to all the previous variants that we've had. But that uncertain outlook sort of keeps, the investment side of things it makes it a bit unclear. Right now, in terms of response to the outbreak, we've seen lots of travel restrictions being implemented. We are yet to see lockdowns being introduced, but there are talks that could be introduced depending on findings that are being discovered in the coming weeks, because there are lots of work and research being done to sort of understand the impact of the Omicron variant on the health of the carrier, and then also to look at either existing vaccines are adequate enough to sort of protect and provide significant protection for immune systems of people who have been fully vaccinated. Because you look at, for example, the cases recorded in the United States, The 2 cases recorded so far, the two persons involved have been fully vaccinated. One of them even taking the third immune booster that was introduced sometime last month also. So all these are raising concerns, but a lot is still uncertain. A lot is still unclear on how dangerous this virus strain is. And as a result, the investment landscape remains unclear. But clearly, we have seen significant negative reactions due to due to the initial concerns that the variant may not be very susceptible to the existing vaccines that we have and all the antibody treatments that we have currently. So it's a bit unclear, it's a bit muddled, but the economy, the investment landscape would continue to rely on more information that comes in over the next few weeks.
Okay, bringing it home to Nigeria, we've seen crude oil is a critical economic variable for our economy. Since the announcement of the discovery of the new strain, we've seen Brent lose over 15% and breaking below the $70 per barrel mark. Does this represent a serious concern for Nigeria, considering that we rely so much on oil for our revenue?
Definitely, anything that impacts on crude oil prices is critical for Nigeria. We know that the economy depends significantly on that in terms of our foreign exchange earnings, in terms of our import earnings, and even in terms of the size of the economy. We know that there is a significant dependence on crude oil price. And so far, due to the travel restrictions that we've seen, reintroduced across the globe, there's a lot of concern that it could impact on oil demand, and as a result, we've seen oil prices tank significantly. Now, how does that impact Nigeria? Our 2022 budget has an oil price benchmark of about $60 per barrel, and on Wednesday, crude oil price broke below $70 to about $68 per barrel. But we've seen it sort of trend a bit higher back to $71. And the further oil price is away from our budget benchmark, the better it is for the Nigerian economy. So it's very critical for achieving our budget targets for next year, particularly in terms of revenue. Number two, in terms of our foreign exchange earnings, is also critical because you look at our crude oil production so far this year, we are yet to return back to our pre-COVID production levels, largely because of some structural bottlenecks across key oil installations across the country. So what has been compensating for that reduced production has been the resurgence in price. So if we begin to see depressed prices over the next couple, if we see prices remain depressed over the next couple of months, then it would become a significant concern in terms of FX earnings and acquisition to reserves and exchange.
All right, Akinloye. How do you expect economic policymakers, both fiscal and monetary, to actually react to these developments, given that most of the policy narrative in recent times have shifted towards tightening? A quick one, please.
Okay, yeah, so quickly, clearly, most economic authorities will largely still continue to watch how the virus strain evolves, based on more information being available from scientists over the next couple of weeks. That will shape how economic authorities would react. If the virus strain is described as more dangerous and more concerning, then we could see a situation whereby economic authorities may relax their tightening stance in order not to hurt the economic recovery that we've seen so far. But if it's a situation whereby the existing vaccines are able to provide a decent level of protection against the new variant, then we might see that sustained tightening narrative over the next month. So it's largely dependent on what the science tells us over the next couple of weeks as more information is made available on the new virus strain.
All right. Thank you very much for your time, Akinloye Oyorinde. Thank you for your time.
Thank you very much. Thank you for having me on the show. It's always a pleasure.
Right. Okay, in the meantime, some African presidents and private sector players have been meeting in Cape Verde discussing new ways to finance Africa's post-COVID-19 recovery and accelerate its development. The African Economic Conference 2021, which started on Thursday, has the theme Financing Africa's Post-COVID-19 Development, and it's organized by the United Nations Development Programme, the African Development Bank, and the United Nations Economic Commission for Africa. Now let's cross over now to the event to have a feel of some of the conversations there. And I'm being joined by the Chief Economist, Regional Bureau for Africa at UNDP, Dr. Raymond Gilpin. Thank you very much, Dr. Gilpin, for joining us on the program.
Thank you. It's a pleasure to be here with you.
So how does vaccination rate influence development financing for African countries?
Thank you. This is an excellent question. The new Omicron virus lays bare a reality that Africa has been anticipating for quite a while. The fact that vaccine availability, particularly across the continent, has been such a problem, and only less than 10% of eligible Africans have been vaccinated, has had a very dampening effect both on economic growth and on economic development prospects across African countries. This downturn has also had a negative impact on foreign direct investment flows, as well as both remittances and portfolio investments. And the bottom line is that the critical investments that Africa needs at this point, not just to get over the impacts of COVID-19, but to build forward smarter, stronger, and more sustainably, have been constrained.
Now, Africa has always had a higher risk profile. Did the pandemic really make it worse? Is there any way this inequality could be reduced?
Well, that's a debatable concept, actually, whether or not Africa really has a higher risk profile, or whether risk in Africa is not being priced properly. There's quite a lot of research that shows that understanding risk in Africa is something that has not been really explored, and because of that, investments in Africa, borrowing by African entities and African countries is a lot more expensive than elsewhere. And so I think that we need to dial it back a little bit and better understand the risk profile. But be that as it may, as in any investment destination, there is an element of risk on the African continent. And the thing that we are learning from COVID-19 is that if we do not have a global approach to vaccinations, global approach to recovery, and then we have a problem in which the risk just gets particularly worse. It becomes a self-fulfilling prophecy. And this is why here at the African Economics Conference, we're exploring innovative ways to think about how to attract the resources necessary to allow African countries, African companies, and African households to better prepare for the future.
Okay, now how can African countries or leaders apply the suggestions being made at the conference to improve their GDPs or their economies? Are the suggestions practicable enough?
That's an excellent question, because normally when you have academic-leaning conferences like the African Economics Conference, we think about these big ideas, complex macroeconomic modeling, and also very, very dense data. Here at the AEC, we have brought together the thinkers, people who are working on these evidence-driven solutions. We've brought to also have leaders. We've had heads of state, heads of government, and we've had the private sector leaders. We have a youth panel, and we have broad range of representation. What does this do? It enables us to interrogate a lot of the challenging scenarios we're putting on the table. Are they practicable? Do they really relate to Africa's challenges today and the emerging challenges for tomorrow and the years ahead? How does all of this get us on board to meet not just the Sustainable Development Goals of 2030, but also the African Union's Agenda 2063? It's very important, and one of the things that we are emphasizing here is that there is a sense of urgency. We do not have the luxury of time. And so we are putting together proposals that look at how we do development differently. For 60 years, we've been doing development one way, and it hasn't taken us very far. Between 1990 and 2020, $1.3 trillion worth of aid came to the African continent. Over that same time, per capita income increased by only $350. The proposition we are putting on the table is, how do we harness not just development aid, but mechanisms to enhance domestic resource mobilization, ways to involve private capital flows, the $100 billion worth of remittance flows that come into Africa, how do we repurpose those to help fund development? And then also taking a look at the reserves of African institutions, banking institutions, sovereign wealth funds, pensions, savings of African diaspora. How do we redirect those to help finance the vast and complicated challenges that the continent faces? And we do believe, and we have seen through not just our plenary conversations, but a lot of side meetings, we are seeing pathways that are pointing towards ways to do this better and more effectively in the African continent. And one example of this will, of course, be the Africa Continental Free Trade Area Arrangements, which allows African countries not just to trade amongst each other, but to collectively, in partnership with the business community, both formal and non-formal, to expand the size of the African market to about $2.5 trillion in a few years.
All right. Thank you very much, Dr. Gilpin. Let's just hope that this conference provides an answer to some of those questions that you have raised there. Thank you. We do appreciate your time, and have a wonderful deliberation there.
Thank you very much.
Dr. Raymond Gilpin is the Chief Economist, Regional Bureau for Africa, speaking to us from the African Economic Conference taking place in Cape Verde. Okay, let's now do an opening call to the market, and we have Anyete there standing by. Hello, Anyete. Good morning. So what do we have? Still red.
Jimmy, it's been a bloody week. Let's just call it a financially bloody week for the market. Well, of course, I must tell you, the last 2 days has been just on one particular equity, MTN Nigeria. So let's give you a rundown of what happened at the market yesterday. An additional 130 billion naira is knocked off from the total value of listed equities, which translates to about 520 billion naira erased in just 4 days this week. And that's against 630 billion naira gained within the whole month of November. So that's, if you do the calculation, that's about 110 billion naira, just a little in between the value in between what is gained and what is lost. Now, also, in sectoral performance, like I said, it's all bloody there. The only green there is consumer goods, and that's just as at Thursday. On Wednesday, it was only the insurance sector. And that's, of course, it comes after the likes of GT Co, that's Guaranteed Trust Holdings, as well as Zenith Bank, Seplat, and Lafarge, as well as some other more. We had about 31 losers. So, but depending on what side of the coin you belong to, what someone's gains could be another person's loss, vice versa. So this is how it printed. Then in terms of volume, it was down by 3.4% to this figure here, 32.01 million units of shares transaction carried out in 4,706 deals at a value of 5.29 billion naira, which were in the green in contrast to the previous session. So that's how the equities market turned out. But if we have our guest, our analyst there, Afolabi Benro, who is an equities trader, okay, I think we have Afolabi to give us a rundown of what happened in Thursday's trading session and also for the last 4 days. Thank you for joining us, sir.
Good morning, Anita. Thank you for having me.
Okay. So now, of course, you're quite aware of the trading, the lackluster performance at the NGX this week. So can we really attribute the last 2 trading sessions, of course, You traders were expecting that this week will be positive for the market, especially when investors are positioning for full-year earnings declarations. So what happened?
So I think from a couple of the stocks that you mentioned. So let's take MTN for example. So MTN dropped yesterday, and this can basically be attributed to the fact that the retail offer is now open, and that has been priced at 169 naira. So it's not surprising that the market is converging sort of towards that price. So it drops from 171 to 169.20. So far this morning, that's where we're seeing sort of the bids happening. Also yesterday, we saw a drop in Seplat. It closed at 650 naira. This was on the back of a structured transaction of about 1.5 million shares. And this happened because, the buyer seems to be at the lower end of the market. So we're seeing that trend. Elsewhere, we're seeing some selling pressure in GTCO, which is causing the stock to drop as well. So, I mean, all these in combination is what is attributing to the performance of the market so far. As you mentioned, investors are usually at this time sort of taking positions ahead of full-year dividends that are going to be announced next year. I think that's still happening, and it's probably going to continue happening throughout the month. But because of those other factors that we have seen, the market is very bearish right now.
Okay, so Afolabi, thank you for giving us that update on the market. And surely we will look out for how Friday's trading session turns out for equities. Okay, so Chimi.
Well, we continue to monitor these numbers and hoping that perhaps something, it might just turn around today. Thank you, Anita. All right, let's cross over now to London to see what's going on there. And we have Juliana. Hey, Juliana, good morning.
Good morning, Chime.
Well, I can see you are already in Christmas mood, looking at that beautiful Christmas tree there. You're already in a Christmas mood.
Well, hopefully, as long as we don't shut down anytime soon, keep your fingers crossed for us.
Absolutely, absolutely. I keep my fingers crossed. All right, the $75 billion takeover of Cambridge-based chip designer ARM by its rival NVIDIA is in jeopardy after U.S. regulators followed the UK and Europe in moving to block the largest semiconductor chip merger in history. What will this mean for the chip market, which is already in shortage?
Yeah, this is a really interesting story. It's been going for over a year now when NVIDIA, which is a huge chip company looking after artificial intelligence and intellectual property based in California, they put in a £65 billion bid to buy ARM, which is actually owned by Japan's SoftBank, but is still based in Cambridge. In fact, ARM is considered one of the most successful British companies to be made in decades. They put in the bid in September 2020, but alas, we were in a lockdown, and then we started realizing that there was a serious shortage of semiconductor chips, the one thing that this company has been making. Now, the Competition and Markets Authority, a British regulator, got involved, looking at the details and the intricacies of this deal, and that's actually gone into phase 2. European regulators are also looking at the merger, and now, just last night, the US Federal Trade Commission have actually started legal proceedings. Even though NVIDIA is an American company, they're not happy with the deal as well. They think that it's going to stifle competition. This could be the final nail in the coffin, but of course, no surprises. NVIDIA are seeking to appeal. They said that they are going to show regulators that the way they will be running the business will be as clean and as above board as possible. But their share price has risen 145% this year alone. So it goes to show that investors really want to get their hands on this deal.
In the meantime, the family owners of Selfridges in final talks to sell the luxury department store group to a Thai conglomerate for an estimated £4 billion. What more are you learning about this?
Yeah, well, Selfridges is a property of high interest in. It's not just the Thai company who are called the Thailand Central Group that have put in a bid for Selfridges. There are several companies that are interested, including a US private equity firm, but it does appear as if the Thai Central Group have reigned supreme and will get their hands on Selfridges. It's not just the flagship store in Oxford Circus, which I'm sure everybody's familiar with. Selfridges actually have about 60 stores across the world. The Weston family, the Canadian family, purchased it for a steal back in 2003 for about £598 million. It's now worth over £2 billion. We're not exactly sure how much the transaction price is. Some say it's anywhere between £4 and £6 billion. We know that the patron of the Weston family died very sadly earlier this year. So that obviously the Weston family now are keen to get it off, even though we know the British high street and high streets across the world are evolving because of e-commerce. It's still a very, very, very lucrative still. Hopefully that's where I'll be getting your mulberry bag from.
I'm still expecting it. I'm still expecting it. Well, if it's not coming now, at least there's Christmas coming. So it's going to be my Christmas gift. Okay, thank you very much, Juliana. So we hope to get more update from you later in the day. And it's on that note that we draw the curtain on today's edition of the program, and of course for the week. And of course, don't forget to join us at 1:30 this afternoon, Business Incorporated, for more updates on developments in the world of business. I'm Chimeze Obi Iwawu.